Hi, this is Todd with a video update. Hope everyone's having a great end of summer. We're going to talk today about what is your game plan. Some of the things I've been hearing from clients here recently and wanted to pass on, just different things that people are thinking about. So right now we're in the longest bull market ever, 10 plus years. Central banks are using extraordinary measures to keep interest rates low. Global corporate and government debt is elevated this late in a recovery. How much risk do we need to take to hit our goals? Are we prepared for a recession? And how is our personal debt and cash flow? So we're going to discuss these topics. You can pause any of these slides to see in more detail because I'm going to move fairly quickly. But it's important to determine what our goals are for the portfolio. How do we get our fair share of returns over decades? How do we survive the short term to win in the long term? What do we own? What are our cash flow needs? And planning for recessions and rebalancing over time. So my job is to help clients make rational decisions about their money based on a lot of data and analysis. I'm a teacher, I'm a bouncer, I'm a coach, and we help clients focus on optimal outcomes and help clients get stuff done. It's important to think about this framework as we go through so that we can drive optimal outcomes over time. So a lot of times people can confuse risk and volatility. So risk is not volatility, the ups and downs of the market. Risk is more long-term, and you need to think about that when you're investing in stocks. So risk is outliving your money, not achieving your lifestyle goals, panicking at a time of a recession or big losses in the market. So we want to focus on this over time, this side, and not be too concerned over short-term volatility over 1, 2, 3 years. It's important to think about your portfolio construction and asset allocation to understand the volatility in your portfolio. So for a typical 60-40 portfolio right here, about 90% of the risk is from stocks. So even though you have 40% in bonds. So a 60-40 portfolio typically would be about a 25% or so loss in a large recession. So for most people, we think about having stocks somewhere from 30% up to maybe 80% if you're younger and more aggressive. And these are the respective losses of those types of portfolios from a projection standpoint. So if you need help in this, we can certainly help and adjust these over time. People don't realize how quick and painful bear markets are. So bear markets happen very quickly. In fact, the average of the last 5 bear markets has been down 36%. In a 27-month recovery. But you can see several of these have been close to 50% losses. So the losses are quick, they're swift, and when we have bull markets, those are also very positive. The average returns for this bull market has been 14 to 16%, and that's very typical of other bull markets. So we want to make sure we're invested for the long term and have the proper amount in stocks. So when you think about a 60-40 portfolio, and again, you can pause any of these slides. These are since 1935 or the 30s. This is a 60-40 portfolio with rolling returns. And the interesting thing you can see here is this pink box here is returns for a 60-40 portfolio above 8%, as high as 16%. In fact, here in the 80s and 90s, we had 23 years of returns with a 60-40 above 8%, as high as 16%. You can see we've also had some periods, the great financial crisis, coming off the gold standard and a recession here back in the 70s, and then obviously the Great Depression in the 30s where a 60-40 portfolio had really bad returns. So right now we're a little bit elevated here, above 8%, given the last 10-year returns and the strength of bonds. And many people would project both lower returns for both stocks and bonds over the next several years. And we should plan for this as a base case scenario. Since 1995, stocks are up about 8% per year, almost 9% per year, and bonds were up 5.2%. Since 2000, it's been very different. Stocks are only up 5.5%, and bonds are up about 5%. I'm going to discuss this later in some slides, but bond yields will not be returning 5% per year in the future, something much lower than that. So here's a chart that looks back to 1996. 3 bull markets, 2 really big recessions. And you can see right now we are up 448% with dividends included at all-time highs or close to very all-time highs. And we should be expecting volatility and maybe lower returns moving forward. As you can see here, growth has led year to date. Growth has led since 2009. And growth is probably more expensive than the past 20 or so years. And this would lead us to believe we might have lower returns moving forward. In fact, today, tech and growth have been dominating. The top 6 companies account for 17% of the S&P 500, and that's the same as the bottom 290 companies account for 17%. And you can see how this leadership has changed over time. So back in 2007, pretty diversified, ExxonMobil, GE, Microsoft, and many others, Procter & Gamble, Walmart. Today, the S&P 500 is dominated by tech stocks. Microsoft, Apple, Amazon, Google, Facebook, and Visa even here. So it changes over time, but obviously a heavy weighting in tech today. So if you look at the last 12 months, this might be surprising. Again, you can pause any of these slides, but over the last 12 months, bonds have done better than most stocks. So you have low volatility has been the best performing, up about 16%, but the bond index is up about 10%. And the S&P 500 right here was only up 3% over the last 12 months. So this does happen from time to time. So again, the bonds or T-bills outperform stocks only 35% of the time over a 1-year basis, and less than a 14% chance over a 10-year basis. But it does happen. So we have bonds for reducing volatility and providing rebalancing opportunities over time. If you look at since 2018, you can see a little bit of a different story. So again, high growth, dividends, and momentum have done better than the S&P 500, and bonds have done slightly worse since 2018, up 9% versus the S&P 500 up 12%. If you look at the last 3 years, again, it's been led by tech, up 76%, momentum, growth, dividends, and so forth. And then here is the S&P 500 up 42%. And international and bonds and value have done worse than the S&P 500. And over the last 5 years, tech again has been a big winner with momentum and dividend growth. And small cap stocks and international and bonds have done less than the S&P 500. So when we think about the market today and moving forward, over the Trump administration, monetary policy has been positive. It's been easy. Tax policy has been positive. Less regulation. Size of government has increased, which is a drag on economic output and potential returns. And trade policy has been neutral. Obviously, China has been negative, and that's a big detractor here, and a lot of the next 2 years or so depends on this. But it's been positive with Mexico, Canada, Japan, and the EU. So we may, if we can get this worked out, we may go higher for longer. Bonds. Bonds have been really problematic. Central banks are using extraordinary measures to keep interest rates low. This is the yield chart of negative yielding bonds all the way out to 50 years in some countries. But look at how many at the 10-year bond level is negative across the globe. So a lot in Europe. The U.S. was around 1.7%. So still very high here, but globally a lot of negative yields. And the challenge with negative yields is starting yield is a very good predictor of the returns you're going to be getting over the next 5 years, 5 to 10 years. So starting yields being low, that means bonds are going to return significantly lower than they have in the past. Over the past 20 plus years, it's been over 5% returns. And today, starting yields are below 2%. So we expect much less returns from bonds over time, unless we go to zero like a lot of the rest of the world. Again, this chart here shows bonds are highly correlated to starting yields, and we're down in this section here. So we expect low returns for bonds. So international stocks, one of the questions we've gotten from clients here recently is, should we even bother with international stocks? And I think the answer is yes. The MSCI All World Index has about 55% U.S. stocks. We have more like 70% U.S. stocks. And you can see it's pretty split over long periods of time. This is since 1970. Sometimes the U.S. outperforms, sometimes international outperforms, and it's a very good diversifier over time. Here's a chart that shows population. The U.S. is 5% of the world population, but it's 55% of the stock market capitalization. So when you think about gross domestic product GDP globally, the rest of the world accounts for a lot of growth and opportunity, especially emerging markets where we tend to be overweight. Here's some returns of the U.S. Obviously, very good returns since the '09 lows. The rest of the world is not only much cheaper, but they've had lower returns over that period. So the international markets may go on to outperform. And we have seen this in the past. So U.S. stocks are expensive compared to the rest of the world. In fact, very expensive compared to history. And you can see, actually, we've had periods in the 2000s where the S&P 500 lost money for 10 years. But this is U.S. large cap value, small cap, international and emerging markets. And if you look at over since 2000, the 19.5 years, value, small cap, and international have all done better than the S&P 500, only returning 5.6%. So the key takeaways is, what is our game plan? How much risk do we need to take to accomplish our goals? What percent equity is prudent at this stage of the life of the business cycle? And do you think we'll have a recession in the next 3 years? The odds favor that. So we have to have a plan for recessions, and we have to plan out your lifestyle and retirement. We should focus on paying down some debt. We have to focus on having discipline and not chasing hot stocks with no profits. Having an emergency fund, something like a Capital One money market account paying 2%. Keeping some dry powder for buying more stocks in a recession. Saving more and spending less, and focusing on health and gratitude and being less busy and spending time with our family and other important things. So think about these things and how we can implement these in your portfolio and your life. If you need help, please reach out to us via the calendar link, and we can help and set up a time. And thank you for watching.